Good day. I'll be walking you through my financial model, which is about establishing which one of the three options is the most lucrative option for a client. The first option was to rent out an unfurnished apartment. The first costs were calculated and they amounted to 57,000 rands. The maintenance costs were calculated using a rule of thumb that states that 1% of your property value should be dedicated to your maintenance and repair costs, and the property value was estimated using by assuming that it increases with 50,000 rands per year. You have the revenue. We have two types of revenue: the rental revenue and the client's salary. The rental revenue was assumed to increase every 2 years with 8%, and the 800 rand based off of the fact that we replaced the tiles with the laminated floors. We included the 800 rands, the property levies and the property rate and property taxes were assumed as follows. They were calculated as follows. The change in the levy and the change in the rates and the taxes were calculated, and an average of the change for each was calculated, and it was assumed that every year the levy and the rates and the taxes would increase by that average. And then to finance these first costs, you could either refinance a mortgage bond or take out a personal loan. The two options were compared, and it was decided that it was going to be much cheaper to take out a personal loan, because if you refinance your mortgage bond, you have to pay it over 20 years again, which will cost more. So it's better to take out a personal loan. Okay, the after-tax cash flows were calculated. They incorporated the depreciation of the stove, the interest on the mortgage loan, and the interest on the personal loan. They took all of those into account, and then the after-tax cash flow was calculated. Okay. It is important to note that a net present value is going to be used to establish which one of the options is the most lucrative. And the planning horizon is from 2019 up until 2023. Okay. The more after the tax cash flows were calculated, the more estimations we calculated. We estimated that we need to at least have an interest return of above 10%, the 10% from the interest loan, an opportunity cost of maybe investing the money in a unit trust was lost, so it was added, and a risk because with renting, you could have a vacant apartment. No one could. You could have a scenario where no one rents out your apartment. Okay, and then the after-tax more were calculated accordingly. Also, the tax rate was assumed to be 41%. This information was taken from the SARS fact sheet, and obviously it increases with 4% every year as given in the brief. From there, the NPV for the cash flow was calculated. Then it's assumed also that at the end of the 5 years, you sell the property. And if you sell the property and you include all the agent fees, transfer fees, the capital gain, which was taken from the SARS spec sheet, and a moving average of the capital tax gain was calculated for the next 5 years in order to have a capital tax gain value in 2023. And after all of these were taken into account, you now had to pay your mortgage bond. And after you pay your mortgage bond, you're left with 500,000 rands. almost. And again, the money that you left with, the NPV was calculated, added to the NPV from the cash flows, and a net present value for selling the apartment of almost 2.3 million was calculated. The second option is renting out a furnished apartment for short-term rentals. I chose to rent out the apartment with the Airbnb, okay? And Airbnb gave me an amount of 10,833 for now, and I calculated an inflation rate for this rental amount for the next 5 years. The inflation rate estimations were taken from a fact sheet. A moving average of this inflation rate was calculated for the next 5 years, for the next 5 years, and the amounts were then of the rent amounts were then inflated using the inflation rate. Okay, the income is as it was before. It was given, increasing every year with 7%. And it's important to note that the agent commission for the previous option was assumed that you're going to have one client for the 5 years, so you only inquire one commission. For this option, we assume that it's short-term rentals, monthly rentals, meaning that you're going to need the agent on a year-to-year basis. That was assumed. The tax, again, 41%. Levies remained the same. Again, a comparison between either taking out a personal loan or refinancing your mortgage bond, and the personal loan was selected again because it was the lowest, and the after-tax cash flows again were calculated for this option, taking into consideration stove depreciation and furniture depreciation, and they were calculated, and a net present value was calculated for those cash flows using the MAR estimations. And for this case, we increased the risk to 15% because if you're renting out an apartment on a month-to-month basis, there's a higher risk of you not getting any clients because it's a month-to-month basis and it's not a one-year lease. Again, the after-tax MAR was calculated, and again, you sell the property, you pay off your transfer fees, your agent fees, your capital tax gain, and you pay off your mortgage, and this is what you're left with. Your NPV for option 2 is almost 2.1 million rands. Option 3 is simple. We choose to sell the property immediately, and we take out a loan to finance the plumbing issue, and we invest money in the Ellen Gray Foundation, and the fee for this is 1.78%, and that's what we do. And we calculate the cash flows, no depreciation, because all we're doing is reinvesting money. And the net present value here was calculated as 2.3 million rands. A sensitivity analysis was conducted on the MAR, and it's evident that obviously if the MAR increases, that means your risk increases, your net present value decreases, but still option 3 was the most lucrative. We did a sensitivity analysis on the capital tax gain, and it doesn't matter that there's a break-even point because you're going to invest in the beginning. You're going to sell your property in the beginning. And I recommend that we choose option 3 because it has the highest NPV value, and you don't have to pay any levies, any property taxes. You just take your money and you invest it. Thank you.